Hello, everyone. Welcome back to part two of our discussion of chapter 11. I told we were going to just do two parts for this chapter, but I think that we're going to end up with three. So just note that there will be a third one after this one. Okay, we had talked in the first one about employer-sponsored plans, and we just got started into individual sponsored retirement plans that we need to consider on, and then we're going to talk about in this as well the education type plans, these that are separate, that work very much like these retirement plans but have some different rules. All right, so talking about IRAs, something about married taxpayers, some rules that you need to remember. Okay, if both are employed and neither are covered, but neither of them have a 401k at work, they can both make a deductible IRA. So your total IRA contribution, it could be $12,000 or $14,000 depending on their age. Okay, for the spouse. Remember, they're filing a joint return. Okay, so they're going to both be reported there in the same way. Okay, if only one is employed and that is not covered under the employer plan, they can't. So if the other spouse doesn't have income, okay, for whatever reason, they stay home and take care of the kids, they starting their own business, hasn't got any money, hasn't got off the ground, okay, and whatever reason, one spouse is employed, the other, they can make a contribution for both spouses, okay, up to the limits, as long as they're not covered by the plan at work. If one spouse is covered under the employer plan, then that limit we talked about in the first group applies to that spouse. But the other one doesn't, also is employed, but doesn't have a plan at work. Then they can contribute as long as the total AGI is under 204,000, and then even that one phases out. Okay. At 204, which is much higher than for the spouse. So this is for the spouse that is not participating with the employer plan. So moving to Roth IRAs, a little bit newer. Okay, we've had IRAs for a long time, and then we created Roth IRAs. The contributions are not deductibles. You put money into a Roth IRA, it doesn't give you any current tax benefit. But when you take the money out, it is non-taxable, and all the money you make in that plan during that time is also not going to be taxable. Okay, so that is the incentive, is you can make all this money inside the Roth IRA, and there's a whole lot of people out there that believe that you make gobs and gobs of money with all this great investing advice that you're going to benefit tremendously tax-wise because you'll be able to pull all that out tax-free. Okay, that's for a decision about your financial investments and things, not a tax issue necessarily. Okay. However, you can't even put money into a Roth IRA if your income is too high. Okay, so if you're married filing jointly and your joint income is 204, okay, it starts to phase out, and it's phased out over 10,000. Notice the phase out ranges, all these different phase out ranges, then different for married and single and all that stuff. Just look those up. You'll no way to remember all of them. Okay, different ones for different types of scenarios. It's still 6,000 limit total. And by the way, it's also Roth IRA or regular IRA. You can't do both in the same year either. At least the full 6,000. You can split it between 3 and 3 if you wanted to, or something like that. Phased out, and if you put money in to a Roth IRA when you are not allowed because of your income, it's not like the IRA situation where it just becomes a non-deductible because it's already non-deductible. It's actually a tax on excess contributions. They charge you an extra tax on that excess contribution, the amount you put in that you weren't allowed to put in. Unless, of course, you take it out quickly because you realize that you are not allowed it. Okay? So the basic idea of the difference between the two, whether it's taxable, you get tax benefit now or in the future. Okay, traditional and Roth IRAs are the two types of individual sponsored retirement plans. Okay, single individual 58 with wages of 30,000, tax deductible contributions 7,000 because they're over 50, right? Because they get the extra catch up. A married couple who are not participants in employer with earned income are ineligible. Notice it doesn't matter if you are not a part of a plan at work. Your income has no bearing on whether you can make a deductible contribution to a traditional IRA. Okay? No, it could be 500,000, it could be 10 million. Okay? It's still, you can still make that 6,000 depending on your, or 7,000 depending on your age. Okay? And generally distributions from Roth IRA are not taxable and very flexible on taking that out, even if it's before retirement per se. So, what about non-retirement plans? Well, Coverbell Education Savings Account, a CISA, whatever you want to call it, okay? This works very much like a Roth IRA, and the contributions are not deductible. The account grows tax-deferred, if you will, even tax-free, because in this case, if you do it right, it can be completely tax-free, okay? And distributions are not taxable if you use it to pay qualified education expenses of the beneficiary. So you have to designate a beneficiary. Typically, this is going to be the student, right? So the idea is you designate your child as a beneficiary when they're young, and you put money into it over the time while they're growing up, so that it's, you know, accumulated enough for that to help pay for higher education costs. Okay. You can establish that for yourself or anybody in your family, right? The limit, though, is fairly low, only $2,000 per beneficiary. So if I had 3 children, I could put $2,000 from each one. If grandma contributes to one of them, that reduces how much I can put. It's $2,000 from all sources, right? So if grandma helps, then I can't put 2,000 in and her put 500 too. Her 500 is going to reduce how much I can put in. And again, if I put in money that I'm not allowed to, I would be a tax on excess contributions. Not that it, okay, not like the other situation. And it's phased out, meaning 190K, you cannot, once you phase out 30,000 after that, okay, then you can't put anything in. And if you do, you're charged an excess tax, okay, on that amount you put in. So now 190K is pretty high, so most of the time you can make that contribution and not have that be an issue. Now, even better, and what's made those CISAs somewhat obsolete, is qualified tuition plans, also known as a 529 plan. Okay, again, earnings grow tax-free. There's not the $2,000 limit. There is, as far as from different per beneficiary type of thing. Okay, so much more can be put into these plans. Again, if you pull the money out and use it for qualified education, all right, then it is not taxable then either. Okay, so it can be completely tax-free. And remember, it doesn't get you a deduction currently, right, when you put it in, except this isn't really what we're talking about in this class. In Pennsylvania, if you put it into a Pennsylvania sponsored plan, it is deductible on your state income taxes, which is not what this course is, but just so you know, but has no bearing on your federal income tax, which is what our focus is here. Okay. And then You can accumulate it because multiple people can put it in for the beneficiary. Okay, a lot more money can go in to that scenario. It grows, and then when it's time to go to college, you can pull the money out. The limits on pulling it out, okay, there's one limit, or a couple of limits here. You can pull out for tuition only at K through 12 schools. So that's not higher education. That's for private education. You can do that up to $10,000. So that's still a lot of money. And once in a lifetime, you can pull out $10,000 to pay student debt. But normally it's for tuition and all the other things at higher education scenarios where you can pull out more than $10,000. If you don't use it for education stuff, it's taxable and subject to a 10% penalty, which of course is any of the times when you pulled money out when it's early or not according to the rules, that's the penalty. Okay? If you have it and the individual that is beneficiary of the plan doesn't go to college, decides they want to do something different or whatever, it can be rolled over to another family member. Okay, you can put this money into your education savings account and this qualified tuition plan same year. Okay, and you can use it with your credits. So we learned in chapter 9 that there are credits for paying tuition. So for instance, if tuition at a college is $18,000 and you pull $10,000 out of your qualified tuition plan to pay that towards that still leaves you $8,000 to qualify for the educational credits that you could use. Okay, so you still, if you pay enough, you've got plenty of ways to get tax benefits from that. Okay, so some learning checks. Contributions to CESAs are not deductible. That is true. Okay, and maximum annual contribution per beneficiary, $2,000, fairly low to actually get enough money to go to college. Okay, and it gets phased out if you're single and starting at $95,000, which means if your income is significantly above that, you cannot make that contribution. And distributions can be used for the computer. Is that one of the eligible expenses? And that is true. It can be. Now, when you pull money out of a regular retirement type plan, okay, distributions are taxable if the contributions were deductible. So if you put it into a regular IRA and took a deduction, if it is a 401k, if it is any of those other retirement plans we talked about are qualified and got a deduction when you put the money in, then when you pull it out, it is going to be taxable. However, like the situation I described earlier where your income makes it so that part of your IRA is deductible and part of it is not, then you've got a situation where it's partially tax-free and partially taxable. How do you determine how much that is? Okay, you use the simplified method. This is for a IRA that is mixed. Some of it is regular contributions were tax deductible, some of it were not mixed. The other part is not tax deductible. We go to the tables in the text on page 1116. Okay, you take the contributions that were already taxed and you divide by the number of payments on the table. So the table you're looking at says 55 and under, 56 to 60, 61 to 65. So if someone is 61 to 65 and they've got a partially taxable IRA, then they take the amount that is taxable, okay, or the amount that is from previously taxed dollars, okay, non-deductible contributions, and they divide it by, if they're 61 to 65, 260. If they're 66 to 70, 210. And that's the amount that you pull out that is not taxable now. Okay? That's the proportion of each payment that will be tax-free. Okay? The amount of the payment is tax-free. So we use that table right in the text, not in the appendix, for mixed IRA accounts. If it's just a regular IRA, not mixed, all of it was put in under regular rules, okay, then you have what's called required minimum distributions, RMD, okay? Used to be 70.5, it is now 72. It has to start in the year that you turn, after you turn 72, okay? That means that you have to take it out. So that way, you're using the table in the appendix to Chapter 11, typically Table 3, okay, which gives you an age, and then how much. What you do is you take what you have in your account and you divide it by the number given. So if you're at 72 in the table in the Chapter 11 in the appendix, it says in the age 72 that the distribution period is 27.4. So you would take your balance in your account, divide by 27.4. Next year, you would take your balance in the account, okay, since you're now 73, and divide it by 26.5. And that would be how much you have to take out. You can't just leave it in there. You have to take it out. And if you don't, you get taxed like 50% for missing that. Okay? So you've got to take it out and pay tax on it. Okay? Because that's a taxable distribution. So that's how required minimum distribution. Then each year, you look at your balance, you look at the table, and you divide it to figure out how much you have to take out. Most of the time, your broker or other financial institution that you have your IRA will do that calculation with you, tell you how much you have to take out, and be very helpful in that regard. However, if it's in a Roth IRA, okay, it's not taxable. The only way that you're going to have tax is if you pull it out in less than 5 years, and then you have just pay tax on the earnings. Okay? Qualified education savings accounts we talked about. As long as you pay for qualified education, it is not taxable. Okay? Any premature distributions before age 59.5 for a regular IRA is subject to a 10% penalty. However, okay, when there's been some financial difficulties, typically, there is possibility of pulling the money out without the penalty. It is still taxable, but it doesn't have the extra penalty tax. And the list is quite long in your tax book on page 1119. We didn't reproduce it here in the slides. Okay, so it is. There are some exceptions to the 10% penalty. And you can roll it over to a different trustee. That's what a rollover means. You take it from one bank to another. You don't take the money and spend it. You take the money and put it into a new one. Okay. If you put it into a Roth IRA, then you have to pay tax on it. If you put it into another regular IRA type account, then you're good. And let's say you had distribution from an account and you didn't know what you were going to do with it. Maybe you actually thought you needed the money for something, some type of emergency. But then it doesn't happen. Somebody else helps you out and you don't need that money. As long as you put it back into another IRA within 60 days, okay, you're good. If you go up past 60 days, now you've got a taxable distribution, and you've got to have, and if it's early, and because you didn't spend it on any of the exceptions, you're going to have a penalty as well as a tax on it. So typically what you want to do is do what's called a trustee-to-trustee rollover, where basically you tell the one trustee to send it directly to another trustee, and you don't have any issue with the taxability of it. Okay. Defined benefit plans, like we talked about, is a pension, pays out a certain amount every month, every year after retirement until you die. Okay. Distributions from qualified pension plans may be taxable or non-taxable, because you could have a mixed IRA. You can have even regular 401k plans where there's a mix of them, but typically not a real common. Using the simplified method that we went over in the textbook, then if you is 68, the number of payments that if you were doing a mixed IRA, you would take the already taxed amount and divide it by 210. 210 in that situation, according to the table. And if you were a married couple, there's a second table right below it, okay, that adds your ages together. You'd add them together, you get 122, and you divide by, you take the amount of already taxed contributions and divide by 310. And distributions are required once you get to be 72, right, from a traditional IRA, not from a Roth IRA. That's one of the things that they sell a Roth IRAs on, is you never have to take a minimum distribution. If you have other sources of income, you don't need that money. You can just leave it in and leave it to your inherited by your kids or something like that. IRA distributions are taxable if funded with deductible contributions. That is true. Typically, any distribution out of a retirement plan, the first thought is probably it is taxable, okay? And distributions are never required of a Roth IRA, as we discussed earlier. For an individual age 65, Roth IRA distributions are not taxable if they've been held for at least 5 years. That is true. Okay, and you cannot just use your Coverdell Education Savings Account. Once it gets 30, the rules don't drop away. You can redesignate the beneficiary, since that first beneficiary maybe didn't use it because they didn't go to college or got a full scholarship or something like that. All right, then you can roll it over to another when they age 30, but you can't just use it for anything. All right, the last couple of slides on annuities will be in part 3. This concludes our discussion of individual retirement and other savings accounts.